Good afternoon and welcome to the first session of the monthly webinars that CreditSights holds in Asia. My name is Pramod Shenoi. I'm the APAC Head of Research and also the person who's responsible for financials research. I'm delighted today to be joined by colleagues Lakshmanan, Pius Xue, and Zerlina Zeng. And today we'll walk you through the key elements in the credit markets over the last couple of months, because we didn't have one in December. And we'll also walk you through some of our key initiations and recommendations changes. There's a lot of content to go through, so please stay tuned. We will start off with Zerlina. So Zerlina, January is almost over, the first month of the year over. Any key observations?
Thanks, Pramod. I think the key characteristic of January was really lots of volatility in the rates market. People are almost saying there is a bond vigilantes in the DM market. If you look at the US Treasury, it's quite aggressive bear flattening, and that is on the back of the news that the US intervention in Greenland, there is a threat about tariff on Europe, and then further later, there's a JGB sell-off into the US Treasury market. But overall, we still have a preference for duration risk over credit risk. If we look at FOMC meeting, general, it's a non-risk event, but the Fed's tone has turned slightly hawkish. They revised up the assessment for the labor market, and they said the inflation is still sticky, but holding up at a relatively still comfortable level for them to keep rates at the current level. Our general take is we think the Fed voting members still have this slight preference for easing a little bit into the future, even though right now the rates is still balanced for inflation risk versus the labor market risk. Another big news about this month is about the Fed independence. A lot of investors are asking about that. Overall, we think the Fed independence is still intact. Actually, the Powell's relatively strong response to the accusation by the Trump administration, we think it increased the probability he might still stay in the voting committee until January 2028. When we move on to the APAC credit markets, I would say it's still very resilient. It's almost a spread rallying. Reasons being, at the start of the year, definitely there's a lot of capital getting deployed into the system, but I would say the rally is getting a little bit tired. If we look at the Asia IG index, the rally was mainly driven by the defensive credits in the AA and single A category. If you look at BBB, the excess return actually massively lagged the defensive credits. In terms of duration, long end actually generated negative excess return, meaning this month people are dreaming a little bit of the duration, and they are focusing more on the front end and the belly. But our house view is we are still quite constructive on duration. We think whenever the US Treasury 10-year gaps higher, which was the case this month, it broke out at 4.2% this level. We think it will be a good chance to tactically add some duration, not saying aggressive adding because there are still risk event ahead, such as the Lisaku court ruling as well as the IEPA court ruling. And then if we look at the high yield space, it generated 2% of excess return year to date. Very impressive for Asia high yield, but I would say it's also the rally is only just driven by the CCC segment, mainly from the high yield sovereigns. If you look at the corporate space, the rally is actually tapering off compared to December and November.
Fantastic, thanks for that. And it's been a busy start of the year for you. You've been on the road a lot. What are your key takeaways?
Yeah, we are on the road in Greater China region. We went to Shenzhen and Hong Kong. We were in Taipei. We met quite many institutional investors of great breadth coming from the private banks, asset managers, security houses, trading desks. I think a few key takeaways. First one is really there's a lot of capital to be deployed in the system. Talking especially about the Chinese houses, some of them told us that AUM is expected to double over the next couple of quarters. There were more channels for onshore funds to be invested in offshore bond markets through the Mutual Recognition Fund, the South Connect program, and the Wealth program. And then the second one is a lot of our US and European investors are saying, in Asia, do you see a buyer strike? Is there a sell America sentiment? This is also very topical this month. Based on our conversations with our APAC clients, we don't observe this. For instance, the Chinese accounts, when they try to allocate money in the offshore market, the US Treasury is still go-to asset class. And given the rates volatility is already quite high, they tend not to want to add additional credit risk. So US Treasury, even some of the super long dated part, they're also interested in that. The second observation is a continuation of last year's trend. It's continued diversification for our clients across different markets and cross currencies. I think the big markets of interest is Middle East. Our team has been really writing a lot in Middle East, both the financials and corporates and issues and about the Sukuk primer. A lot of interest contact clients are interested in this. I think Middle East is still one region in the banking sector. For tier 2, you can get some spread. There are definitely concerns about macro risk, about oil prices, about the new supply, but overall in this market, it's very difficult to get some spread without taking some risk. It depends on what kind of risk you want to take. Second biggest interest is coming for the Australian dollar corporate bonds as well as financials bonds. This is one trading idea we have been pushing since second half 2024. Last year, this asset class did very well, and this year we think there's still value for allocation. When we speak with the clients, they like the Australian dollar potential appreciation against the dollar. So my sense is maybe 40% of the clients, they actually don't hedge their currency exposure. The yield curve and the spread curve is relatively steeper compared to dollar, euro, and a lot of the APAC credits. And new issue is coming, and we have been writing a lot of Australian dollar new issue this year, and we will continue doing that. My preliminary, my original thought about this was like Aussie rates is going to go higher because RBA might hike, and there's an unemployment, inflation pressure. But actually, because of the very steep yield curve, the market thinks this is already to some extent priced in. So we will be continue writing on corporate hybrid space. We did AusNet this week, as well as some of the kangaroo bonds such as MTRC. This is a market with size and quite good trading liquidity. So I think it'll be continued of interest to clients. Now talking about the risk factors, people are concerned about AI, the bubble bursting, and private credit. And our US team have been putting out quite a lengthy report on this. For AI, we cover the deal flow, the risk reward in terms of spread compression. We talked about the concentration risk, the documentation, as well as the systematic risk. And for AI, it will be a quarterly publication with contribution from our APAC team. We talked about the overbuild throughout the supply chain, utilities, data centers, semiconductors, metals. We talked about the credit risk sentiment, as well as the picks and pans in the sector. So please do pay attention to that.
Fantastic. And on that AI note, we actually just came out with it a few days ago. So you can get a sense of the quarterly rhythm on that particular one. So do watch out for that. Brilliant. So moving on to initiations, then we've had a few come out this week. Maybe we can start off with Pius and GLP. So what's the view, Pius?
Thanks, Pramod. Yeah, so we just initiated on GLP around 30 minutes ago. So it's pretty sizzling hot. So it's got two tickers, GLP SP and GLP CHI. So we initiated on with an Outperform recommendation. On fundamental basis, we are comfortable with the company's access to financing, which is regain access to the offshore bond market. And also it's got a track record in the recycling assets. So this is despite that there's some short-term headwinds, such as still soft logistics rental yield, and also there's going to be a higher expense associated with its effort in going deeper into the non-logistics space, which is data center and renewable energy. On the valuation front, we think that it offers quite a bit of value. It's previously rated BB before rating withdrawal by Fitch. And the two bonds, the two bullets, 28s and 29s, are now trading at 8.4%, 8.7% respectively, and offering around a 480 and a 500 basis point spread. So which is quite attractive if you compare this against Asian BB credits in general, the index in general, and also it's quite on the wide end against several selected Chinese BB names as well. And if we compare this with the two closest comps in our opinion, which is Greentown China and Longfor, we think that there's a potential for it to move tighter against Greentown, so which means that it's got a 30 to 50 basis points of tightening potential. And as to the valuation on its perps, we think that the two perps also offer the value against its own bullets, and it's now trading at around 200 basis points to 250 basis points yield pickup versus its bullets on a post coupon reset current yield basis. So which we think is also attractive versus the Asian high yield space with perp outstanding as well. So just quickly, quick introduction to GLP. So GLP is the leading global developer, operator, and investor in the three key asset types: logistics, properties, data centers, and renewable energy. And it's also one of the leading fund manager across 46 funds in these three asset types as well. As to the key credit considerations, we like GLP's recurring income stream from the rental income, from fund management income. Its long history in operating, investing in logistics assets. It's a track record in the fund launches and recycling assets into its funds or just selling assets outright. And also it's improving access to the capital market, sorted from this May's 300 million new issue after the full year of hiatus. But on the other hand, we are a bit concerned about its high leverage. It's a tight liquidity. It's a geographical concentration after it's sold GCP International, which is its international arm of its asset management segment. So just to help the readers to when they go through our report, there are a few points I want to highlight which can help readers to understand the company better. The first point is that there is a little bit of a complexity around how the company makes money and where the assets sit. A few subpoints here. So for GLP itself directly holds the three asset types, as mentioned just now, on their balance sheet. That's logistics, data center, and renewable energy. At the same time, it generates fund management income as a fund manager over 46 funds, which holds assets in these three asset types as well. And at the same time, on top of that, it also has a lot of skin in the game in the sense that it's a LP investor in many of these funds as well. So that's the first point I want to mention. And the second point I want to mention is the fact that the GLP itself, from a leverage versus liquidity versus solvency perspective, its leverage is quite high. It's 14 times net debt to EBITDA. Its gross interest coverage is just slightly over 1 times. But then when we do our solvency analysis, we are quite comfortable as to its coverage, and by extension, its liquidity options as well, because it has quite a bit of assets on its balance sheet that it can sell, and also it, as mentioned just now, it has regained access to the capital market as well. And last but not the least, just linking back to the solvency point, we did look at trying to spend as much time as possible looking at its assets. It's according to the report, as you know, the company is now more concentrated on the Chinese assets, and its Chinese assets logistics portfolio actually outperform the market average in terms of rental yield, in terms of rental level, and lease ratio. Although we do observe that for some of its top locations, it's facing headwinds in terms like market level, high vacancy rate, and also a lot of future supplies might be coming into the market. So we take all this into consideration when we think about projection for its underlying revenue and EBITDA, and also take into consideration the potential impact on the cap rate when we think about solvency analysis. Thanks. That's so much for GLP.
Thank you so much. And this is a credit which is complex, is unlisted, is unrated, and has yield on it. So if you'd like to know more about it, please do reach out. There's a huge amount of detail in there. So we go from this credit to the other end of the credit spectrum. Laksh, you've recently initiated on Saudi and UAE pipeline companies. What did you find there?
We continued our initiations in the Middle East corporate space by initiating on two pipeline companies. They are Galaxy and Greensafe Pipeline. Galaxy Pipeline is it's in the UAE market, whereas Greensafe is in the Saudi market. But essentially, their business model is quite similar. They have employed a sale and leaseback transaction to lease these gas pipelines over a long-term 20-year lease period. And they have leased back the same assets to Abu Dhabi National Oil Company and Aramco, respectively, for shorter term in lieu of annual tariffs. So the issuers in these cases are essentially what are called bidcos. So they own close to about 47-48% stake in the asset cos, which are the ones which have actually entered into the lease and leaseback transaction with the oil and gas companies. So in effect, these bidcos, we can picture them as being holding companies, having an economic right or a stake of about 47-48% in the asset cos. So to that extent, we do like that these names have very strong counterparty relationships with the national oil companies, which are the quasi-sovereigns of the respective sovereigns. They have very good revenue visibility, and because they have penciled in a tariff structure which has both a fixed component and there's some flexibility to have variability in the tariffs, which in effect gives a very good visibility both on revenues and cash flows over a very long term. These companies also have very low operational risk because a lot of that risk is then carried by the oil companies, ADNOC and Aramco. Even when we look at the debt structure, we are quite comfortable because they have amortization structures in their bond terms and their maturity profile is quite well spread out. And when we look at their equity or the ownership structure, that also gives us a lot of comfort because they are backed by very strong, globally well-reputed equity sponsors, the likes of BlackRock's fund, GIC, some of the pension funds in the Middle East, such as from Abu Dhabi, Mashreq, Mubadala, etc., which gives us a lot of comfort with these bidcos. In essence, the one or two things that we are still kind of a bit concerned about is that at the end of the day, they rely on a single source of income, which is effectively the dividends that these asset cos upstream to the bidcos, which are the bond issuers. And also because, as we just mentioned earlier, that these bidcos effectively act or function as holding companies. They do not have as such any other security over the revenues, cash flows, or any assets for that matter, which are mainly dealt with by the asset cos. So in that sense, we think that, so one of the questions that we have got from a few clients is that, do we still look at them as quasi-sovereigns? That is, do we still look at them at par with ADNOC and Aramco? To us, not really. We think that they are a tad weaker than the respective counterparties, which is ADNOC and Aramco. This is because the bond issuer, which are the bidcos, for one, they are not really the one which are directly facing the counterparties. It is through the asset cos. Second, we picture them as holding companies. They're reliant on dividends. They do not carry any guarantees from the asset cos, and they also lack any kind of security, be it revenues or cash flows or any hard assets. So we look at them in terms of credit profile as being slightly weaker than the respective NOCs. And between the two also, we think that Galaxy Pipeline is better compared to Greensafe Pipeline because of the counterparty being inherently much better than Aramco's in the case of Greensafe. So in terms of recommendation, finally, we have assigned an outperform recommendation on both. We did comparisons with the respective national oil companies because they're counterparties, with the respective sovereigns, and also between each other. We also comped Galaxy with TAQA, which is the Abu Dhabi electricity company. So with that, we see that there is room for each of them to kind of tighten about 10 to 15 bip, 10 to 12 bip more for Greensafe Pipeline because we see them as inherently weaker in terms of fundamentals. And for Galaxy, it is more in the range of closer to 15 bips from the current levels. So that's where we get in terms of the outperform recommendation. Yeah, we'll stop here.
Fantastic. I've just realized that it's infrastructure time over here because the next segment that we've initiated on is on Japanese utilities. So, Zerlina, why don't you take us through what you're finding, sir?
Yeah, sure. Before I talk about that, maybe we'll take a step back. So this year we will be initiating quite a lot in the Japan IG corporate space. Because of the onshore JGB yields has been very volatile. The curve is steepening and the yields is going higher a lot. So for these Japanese IG corporates nowadays, they would like to go overseas market to tap into the dollar primary market, especially if they're looking for some duration. Typically, the demand is better in the offshore market. And for these corporates, when they swap back their dollar into yen, the funding cost is actually comparable and sometimes a bit cheaper, especially for the Japanese utilities company. So we expect this space will continue to be quite active. Now back to the Japan utility sector. Right now they have about $4 billion bond outstanding. Most of them are in 5-year tenor. Some of them tapped a 10-year tenor, but usually slightly short dated. They're in Reg S issuing format. If we compare the Japanese utility sector with the other regional sectors such as Korea and China, they are trading wider. Compared to the Korean utilities, they're about 20 to 40 basis points wider. We think this is fair. We have an outperform recommendation on the Korean utilities companies. So in Korea, these utility companies, mainly KEPCO and their GENCOs, they have an absolutely monopoly in both the transmission as well and generation sector. They also have very strong government support. They're owned by the sovereign and they have very important policy role. So their rating is actually equal to sovereign. Now, if we look at the Japanese market, in terms of the generation and the retail market, they have been liberalized. So the competition is relatively high. In the transmission market and on the generation side market is very fragmented at the regional level. So you have different operators in each different region, most of them having about 30-40% regional market share. In terms of the government support, there are some implicit government support because of their also important policy role in terms of security, in terms of energy security, but there is no government ownership. So we would say that front is weaker. And if you look at the standalone credit profile, in terms of the leverage level, the Japanese utility operators is also a bit weaker than the Korean ones. So we think this spread level is fair and we don't expect to compress very much. Now, if compared with the Chinese ones, it's slightly a different story about technicals. If you look at fundamentals, yes, great companies in China likely stronger credit matrix because they're operating a duopoly market in China. But I think for the China ones to trade about 40-80 basis points inside the Japanese ones is really about the fund flows because the Chinese accounts, they usually will buy the state-owned enterprises and also they don't have much supply into the market versus for the Japanese utilities companies, because of their capex need, we expect the new issue to continue to be very strong, not just the utilities, but the corporates. Now, if we look at the credit fundamentals going forward, we expect overall for the sector, the credit matrix will slightly weaken because of increased capex. Also, even though energy prices are coming down, there's a lag in terms of the price pass-through to the customers as well as reflecting in their margin. So I would say overall for the sector, we have a slightly underweight to market weight that of positioning. Other than what we have said, there are some special characteristics of the Japanese utility sector. One is really about the earthquakes and nuclear-related fat tail risk, and the other thing is about their quite aggressive appetite for overseas investment, and some of them are not necessarily successful, especially JERA. Also, for domestic Japanese investors, we observed they are not necessarily interested in getting Japanese utilities paper. The more preferred sector is bigger companies with more diversified business, like the trading companies. So the technical support is also not there. Now, moving on to the sectors, relative value, we have market perform recommendation on Kyushu Kansai. We see them as having the strongest credit profile because of the integrated operation of T&D and generation. In terms of leverage matrix, they're also better because they have exposure to nuclear and that tend to have better operating margin. JERA, first I go through Hokkaido Electric. This one, the credit matrix is very weak, but the spread is relatively tight. I think this is because they have an anchor investor when they did the new issue. Now, JERA is something we also had a little bit of internal debate in terms of a credit matrix. It looks like quite decent, but then we are quite concerned about its headline risk, its overseas investment. So in the end, we put a market perform recommendation there. So I think for this sector, it does look like there is some carry to go, but I think it's trading wide for the right reasons.
Yeah, so it was a tough one in terms of some of the recommendations, but in general, we've got a market perform and one underperform on Hokkaido. We do anticipate supply to come through. These are companies that only release detailed financials once a year. That's for the year ending 31st of March. They typically release results at the end of April, so sometime after that is when we should see them hitting dollar markets. Thanks for that. Just as a reminder, we have a box at the bottom right-hand side of your screen for any questions. So please do feel free to drop your questions inside there, and we'll pick them up as we get along. Moving now to thematic notes that we put out, it has been an interesting couple of months on the insurance front. As Zerlina pointed out, there was a fair amount of JGB volatility. We had a fair number of investors asking us for implications on the Japanese insurers. As we had highlighted, when JGB volatility picked up last year in March and April, the insurers actually don't get affected too much at all. They have most of their our investments are at amortized cost. They are matching the liabilities that they have, which are very long dated. Some of them, for example, Nippon Life regularly does this. They do take the losses on some of their bonds, but then they reinvest this at much higher yields. So the investment return is very good. More importantly, both under the new Japanese solvency regime, the bonds are marked to market, but so are the present value of liabilities. And so what that ensures is that as the liabilities are being discounted by a much higher interest rate, the present value of liabilities is lower. And so actually solvency, you might see an improvement in the solvency despite the volatility. This time around, it was good to see that we didn't see too much of movement in the Japanese insurers' bonds. As a reminder, our preferred picks over there are Daiichi Life and Meiji Yasuda. Their recent non-call 10s are in the, call it 145 to 150 kind of range. And that's a pretty good spread to us. Moving on in terms of other thematic is Taiwan. So Taiwan announced that they're changing their rules on insurance and the FX hedging policy. As a reminder, the Taiwanese insurers, 70% of their investments are in overseas assets because of the lack of assets onshore. As a result of which they spend a lot on hedging to ensure that they are in line with the accounting rules. The implication of that is that they actually spend more on hedging than there was a number in our report which said there's 1.6 trillion spent on hedging, and the net profits over a period of between 2019 and 2025 was 1.4 trillion. So they're spending more on hedging than on their net profits. They've appealed to the authorities to say, look, this is actually a situation that's really tough, particularly given the volatility and the strengthening in the NTD more recently. And so what the authorities have done is they said that you can undertake some kind of matching exercise. You can amortize any kind of hedging costs over the life of a bond. We understand the value in this because at the end of the day, it's not like they are selling these assets in a hurry. These assets are typically held to maturity, and so there is no need to sell them. The only time that we anticipate that there would be a big impact is in case we see a sudden increase in surrender values, a sudden change, significant tightening, more far above what we have seen in the FX levels, kind of like a combination of these events. But we don't see that as likely, so we have some understanding in terms of why this is the case. Now, the consultation paper is just closed. It was from 19th December for a month. We'll see what next steps are. There is a little bit of a lack of clarity on new capital rules coming through in Taiwan and the intersection of the accounting and capital rules. So we're on the watch out for that, and we'll have updates for you as they come by. And finally, we also had an update from the Korean insurance sector. So the Korean insurance regulator came out with some guidelines to say, hey, we need to look closely at core capital ratio. So what they have observed amongst the Korean insurance company is an increasing use of tier 2 or supplementary capital to boost solvency levels. What the Korean regulator has introduced is a core capital ratio where at least 50% of the capital requirement has to be met by core capital. This is equity and includes additional tier 1 type instruments. So we do anticipate that some of the supply might move from tier 2 format into additional tier 1 format. This is going to be phased in from January 2027 for a period of 9 years. So it's not something that happens in a hurry. There are some caveats along the way in terms of all of the insurance companies need to be moving in the right direction every quarter. Otherwise, the regulator is going to be unhappy with them. And there are some considerations in case they don't do that. But for choice, the implications of this is that we perhaps will see some of the Korean insurance coming in additional tier 1 format rather than in tier 2 format. So lots on the insurance front on the thematic side there. We've also taken a fair number of issuer trips and investor meetings. So in December, the team was in Korea meeting a large number of issuers. So Pius, I'm going to turn to you. Any key takeaways from that trip?
Yeah, thanks, Pramod. Yeah, so we were in Seoul in December and met quite a few issuers under our coverage and also credit investors there as well. So I'll highlight a few of the high-level observations on the macro front and also highlight some of the company-specific takeaways. So on the macro level, it looks like U.S. tariff impact is less than fear. It's because of a production relocation of some of the issuers and also because of this U.S.-Korea trade deal. Although we understand that in the past 1 to 2 weeks, it's on a more shaky ground. And just like general macro-wise, it's better than expected compared to the beginning of the year last year as well, so which is encouraging. On the topic of AI, it looks like the issuers, they are pretty optimistic about the opportunity offered along the AI value chain. For example, in the case of Capco, then that's power demand. Yeah. And then in the case of SK Hynix, then that's chip demand. And for LG Electronics, that's cooling solutions. For LGES, then that's energy. Then that's a battery energy storage system. But we do see that other than the AI theme, we do see that for some of the issuers, there's challenges across several sectors, including steel, including electronics, chemicals, and EV battery specifically. In terms of their interest in tapping the primary market in the dollar bond market, they are pretty interested. They will still be pretty much in touch with the market. They see that the funding cost is similar versus onshore on a post-currency swap basis, and they want diversification in the funding sources as well. So next, let me pick a few of the issuers and highlight some of the takeaways and some of the recommendations as well. So first up on the SK Hynix, the update from it is that demand is very strong across the board. Pretty much it's HBM, it's a high-end chip HBM. It's pretty much 2026 capacity is fully booked out. And customers are now negotiating for 2027's capacity. And they are also seeing rapid ASP increase across both the high-end segment HBM and also the conventional NAND and the DRAM segment as well. On the CapEx front, the company said that they would be prudent in terms of CapEx spending. They would be only doing the major capacity expansion when they see that there's a credible backlog against that. On the recommendation front, so we see that we think that the fundamental is still going to be quite positive going forward. We see there's going to be a positive rating actions from S&P and the Fitch in the next 12 months or so. But then we think that a lot of it has been the price in. So we actually turned from outperform recommendation to market perform recommendation since our Q3 results. So next up, it's on the Posco. The update is mainly by the segment. So on its steel segment, the company is guiding that they are seeing that the domestic steel market is going to be stable in 2026. Inventory along the value chain is being digested, and they are seeing that the export impact from US and EU is going to be small because of their exposure in those markets. It's small. And in terms of its E&C segment, that it's a construction segment. As you can see in the headline, there's quite a bit of site suspensions because of multiple accidents happened last year. So the company would be having some one-off expense, which is mainly recorded in the 2025. It's going to be one-off. So looking at 2026, the base is going to be low. And the company guided that there's not much impact on the backlog as well. Turning to recommendation, we have underperformed recommendation on Posco, and it's mainly on its valuation. It's the high triple B rating credit, but then now it's trading at around the low 8 level in the Korean corporate space. So we have underperformed recommendation on it. And lastly, turning to LG Energy Solutions, which is the most topical one aside SK Hynix. And the update is mainly from the two important segments, the US EV battery segment and the ESS segment. On the US EV battery segment, it's expected that the demand is still going to be weak because of the removal of the RRA consumption tax credit. And for the ESS segment, the company is very confident in its market share gain, and it's going to be expanding rapidly. And in fact, it's going to be expanding its capacity to 40 gigawatt hour by the end of 2026 versus 25. And the company also guided that this segment will command a higher operating margin to the higher single-digit percentage versus the battery segment. But then it's likely that they're going to be prioritizing market shares gains for the moment. So you won't see that margin coming through in the short run. On the CapEx front, because of this change in the focus, change in expansion strategy, the majority of the CapEx will be spent on repurposing the EV battery lines into ESS. But this is going to be a short process, 6 to 12 months from the beginning, and it's going to be a lot cheaper than if the company sets up all these lines from scratch. We do want to also draw our viewers' attention to two pieces of news in December as well. So first up, in the December, it's announced that two multi-year EV battery contracts of total value of $9.3 billion were canceled with the LGES. One was with Ford, one was with another battery pack manufacturer, FBPS. And another news is that towards the end of December as well, LGES JV with Honda sold its building on its production plant for $2.6 billion to Honda. In terms of our fundamental view and also our recommendation, taking all this into consideration, we are cautious about revenue headwind because the US EV market is going to be challenging, and the European EV market is going to be challenging as well for LGES. And we are also cautious about the margin headwind as well, because the ESS, as mentioned just now, is not going to be ramping up quickly and to show the margin advantage over its EV battery segment. But that being said, we are not overly concerned about the liquidity because as shown in the Honda news, the company can dispose assets under its mostly JV structures with OEMs and upstream those proceeds to the holdco if needed. In terms of our recommendation, the LGES bonds are now trading on average 8 to 10 basis points wider than the BBB rated Korean corporates, which we think it's fair considering its fundamentals. And so therefore, we move our recommendation in December from Outperform to Market Perform on the valuation front and on some of the fundamental developments. I will stop here.
Thanks a lot, Pius. Those are a lot of insights and a lot of takeaways. So many thanks for running through that so comprehensively. I'm going to turn attention to the other part of the world now, back to the Middle East, where over the course of December, we had calls with 4 out of the 5 Saudi banks that we cover. I'm going to disperse what my comments are with a lot of the investor questions that we've been getting, which have largely been around oil price falls and the impact on the Saudi government balance sheet and implications thereafter for the economy and for the banks. So as a quick reminder, the Saudi economy is in the process of a major transformation. It's called Vision 2030. And the idea is to substantially increase the percentage of the non-oil economy. The good news is that the changes taken place so far have worked really well. And the authorities are constantly on the lookout for where it is that they need to be spending more money and what is it that they need to be scaling back on. So more recently, you may have seen that some projects on NEOM, like the line, which has been in the headlines for a fair period of time, and some other projects have been scaled back, including the 2029 Asia Winter Olympics. However, there's the full focus on the 2030 Expo and 2034 World Cup, as well as a lot of other projects. So there are a group of projects called Giga projects, which are 5 very large ones in the logistics, entertainment, sports, and hospitality spaces. What we understand is that these are important projects in terms of where the government wants the economy to be moving towards. This was also the time, I think it was sometime in mid-November, that we also had the government coming out with its budget for 2026. So it was helpful to look at a lot of different factors. Simply put, how Saudi looks at things is that these are important investments to be made. If oil prices fall, then they will borrow more. The government debt to GDP is about 33%. The median of single A rated countries, government debt to GDP is about 65%. So the Saudis believe they've got a lot of capacity. If we were to look at the banking sector as well, what we observe is that it's well capitalized. It is well run. There aren't any particular risks that we see, but it is liquidity scarce. And so once you think about the context of oil and you say, right, oil prices, in case they fall, in case they continue to fall from here, what's the implications on the government revenues and the implications for the banks? How we read it is that the government will continue to gain revenues. They'll continue to, the Saudi had actually relatively low GDP growth in about 22-23 when it had held back on production. Now it no longer plans to in the context of OPEC plus. So revenues should be okay. And in case they're not, they're going to borrow. So that channel should be all right. The second thing that the government has done is recognizing that the cash flow to suppliers and contractors might be affected at some point of time. They put a lot of the projects under PIF, the Sovereign Wealth Fund. So that ensures that PIF, with its independent balance sheet, can fund these projects and can ensure that suppliers are paid. The banks themselves have been very careful to say that and whereas there's no public disclosure on this, so we have to take them at their word for it, that they've been very cautious about how they've approached these investments. They have selected which sectors and segments they want to get into. For example, SNB has been more in the logistics space because they're largely a corporate bank. Al Rajhi has been more around leisure and entertainment. They're mostly a retail bank, and that intuitively makes sense for the kind of sectors that are involved. Lastly is that the capital requirements in the country are increasing for the bank. There's a countercyclical buffer of 1% that's going to come in from the middle part of this year, from May 2026. And that there are certain changes to how the Saudi central bank looks at interest rate risk in the banking book. What this means is that the banks need capital and they need liquidity. So we anticipate a fair amount of tier 2 and tier 1 issuance coming from them. It's difficult to quantify, but let's assume at least 2 billion each for the 5 banks that we cover. And in the first week of this month, we already had a couple of banks hitting the screen. So we had both Al Rajhi and Saudi National hitting for 1 billion AT1s. So long and short is that we are a lot more comfortable with the sector, given what we now know. And we have 3 out of the 5 banks that we're covering on Outperform recommendations. In particular, the 10 on-call 5 tier 2, some of which are trading over 200 basis points, offer a lot of value to us. With that, it's a good segue to move into our last segment, which is on recommendation changes. So let's start with you, Laksh. Any important changes over the course of the month?
Pramod. Over this month, we thought that it is quite the right time and it is prudent to book profit on some of our Outperform recommendations in our space. Some of them were in the high yield space, some of them were in the weak BBB minus / kind of special sit kind of situations. First up, we took profit on Biocon. We moved it from Outperform to Market Perform as the bond price, the sold bond, had tightened by about 150 bp from the time that we had put an Outperform at the time of our initiation on the credit. The bond price moved up by about 4.4 cents on the dollar during this time, and it also outperformed versus its peers such as Greencore, UPL, IRB, etc. The fundamental wise, the outlook, we are still very bullish and positive on it. A lot of things have panned out as per our projections, be it kind of revenue growth from new product launches, easing of tensions from potential Trump tariffs on the sector, and also the early stage liabilities have been taken care of. To add to that, the parent has also fully acquired the company, Biocon Biologics, which is the bond issuer. Next up, we booked all profits on Genting Malaysia from Outperform, which we had put on at the time of the proposed takeover by the parent Genting in October. So the bond spread moved from about 232 to 182. That's about a tightening of about 50 bp. So we thought that both our credit view that Genting Malaysia is not that severely hit as part of that stake acquisition, and that rightly panned out with the spread tightening. So we opted to book profit on it. And in terms of the bond price, that had moved up by about close to 2 cents on the dollar, which is for a BBB minus kind of a name. Thirdly, we also lifted our preference on Adani Ports. This came on the back of a news that the US SEC is moved New York court to explore other avenues to pursue its US indictment case against the Adani Group promoters. With that certain development coming into the picture, there was more volatility as well as a bit more heightened governance risks surrounding the group. And even though Adani Green is the one which is at the center of this whole issue and where we already have an Outperform rec, we thought that it is the right time to lift our recommendation, or rather a preference on the Adani Ports, which had already tightened by about 40 to 60 bp during the time that we had a preference on it. Largely, it is not just the outperforms that have worked, even the underperform have worked. So we lifted our recommendation on Greencore Energy from underperform to market perform. This came as our expectation that the fundamentals were weak over the last 12 months had rightly played out. This underperformed its peer, the Renew Power, and also on an absolute basis for select bonds. So for Greencore right now, why we also felt more comfortable with the credit was also because its Pinapuram hydro storage project has come online. The Tista 3 dam, which was under repair, is expected to come online soon in the first half of this year. And thirdly, its credit metric improved, and our expectation as per our 2026 outlook is also for it to continue to improve. So with that, we kind of book profits on that underperform call and moved it to a market perform. So these were the main recs that I would like to highlight.
Wonderful. Just briefly on the financial side, lots of action in Indian NBFIs and MUFG entering Sriram, etc. So Sriram has performed quite spectacularly. We took our outperform off and we moved it to market perform. We also had a couple of other movements, which is Manappuram from market perform to outperform when earlier this month, when the news broke that the Bain Capital acquisition might be taking some time, but it has then retraced to where we see as fair value. So we'll be moving that recommendation back to market perform in a bit. Separate to that, just to say that this is a sector which has received a fair amount of focus. Most of the players now we feel are trading at fair value. The one where we continue to highlight the outperform recommendation is on IIFL Finance, where we think that there's at least another 25-30 basis points of tightening that are left. Other quick recommendation changes is we move from BDO from market perform to underperform, and QNB from outperform to market perform. I'm just going to check briefly with Pius and Zerlina whether there are any other recommendation changes, because I know that you ran through some during your previous discussions, but anything else that you'd like to highlight? Probably not.
I just mentioned LG Energy.
Correct. So that was the only one, right?
Maybe from the local currency front, I think we're getting a little bit of cautious of the long end of CNH bonds. I think the supply-demand dynamic is not that great based on with a lot of Greater China clients. They are quite cautious to taking up long-dated bonds of CNH. And also to highlight, our U.S. team affirmed their positive stance for U.S. MBS. So this security class has received a lot of attention recently because of Trump's intervention in the market. We think when we look at the historical data, when there's a market sell-off, MBS tend to outperform U.S. IG corporates as well as U.S. Treasury. We had an outperform recommendation on this asset class last year, and it did quite well. And this year, we think from a portfolio allocation point of view, it is still worthwhile to allocate there, even though the spreads are very tight, but the spreads are tight everywhere. And lastly, our U.S. metals and mining analyst who covers Glencore, we took profit on this recommendation. It was mainly an M&A acquisition play, and we think that story has largely been played out. We expect spreads to be only a few basis points wider than Rio Tinto, and we think right now the execution risk is relatively high, so the risk is skewed towards the downside.
Wonderful. Thanks for updating us on that. And with that, we'll come to a wrap. So thanks a lot for joining us today. We hope you found the session informative, and we look forward to catching you at the end of next month. Thank you very much.